because it's an important sign of what's to come next. So if you see coins hitting 40%, go and check others. Have a sample size. Take 10 different altcoins across all different sectors and compare them. So Celestia pulled back around 40%, 45%, but others had done 50 and had done beyond. So when the market starts to turn and you're starting to plan your swing trades, you don't have to say, oh, well, it didn't go 50%. Right? If you want to just stick to ones that do 50%, you can. But you can also say, other coins went 50%, so what does that tell me about Celestia? Strength. Right? Pulled back less than the market, there's more demand. Right? Pulled back less than the market, there's more demand. Buyers wanted to get in. So far from being a bad thing, that's a good thing, but only when you apply the context of the market to it. If everything has pulled back between 20 and 40%, and there's nothing yet that's gone down 50%, say out of the top 50 or top 100 majors, I would say it's too soon if it's your first rally off the bear market lows. I would say wait, because that 50%, you want to see at least multiple coins hitting the 50% to give you that first proper reset that's going to give the market a base to then make new highs. That's what you're trying to achieve here. You want it to give a proper reset, the market forms a base, and then runs to new highs. So we also have Avalanche. This one's from the last bull market. Again, this formed in the second stage. So we had a bear market low here in 2020, or at least a low for Avalanche from when it launched, and then a first leg, and then we came all the way down. So this is a little bit like what you're seeing now. A lot of the coins you're seeing right now, if you're looking in 2023, December, whenever I record this initially, a lot of these are going to end up having significant corrections, going all the way down, losing a lot of interest. People give up, they get bored, they stop caring, and it drops all the way down and forms a nice new low, a new base, a new bottom in the future. So if you think you've missed out, don't worry, there will be times to come. And here you see Avalanche, big run up. As this is going crazy and as this is going parabolic, you don't have to chase in. Wait for, just keep marking as it goes. Keep marking your high each day as it forms, and just be patient. It will give a significant correction at some point, and as you saw here, went down to the 50, went down to almost 60, consolidated, held, and then ripped higher. Now, once you get beyond that, the same thing doesn't really apply. Yeah, you typically get one of them, and once you've had that one, and keep note of this if you're trading it here in 2023 going into 2024, any of these ones that have had their 50% correction, and if they start to make new highs and they trade above those highs for a period of time, don't expect them to have another big 50% correction in the near term. It's much more likely that they're going to build and consolidate and go higher over the rest of the market. And here's one to show that it can happen on any coin, even a fucking meme coin like Luna. So bear market lows, pumps up, retraces back, this one about 60%, holds, and that pushes it to new highs. So the principle is that on a daily or weekly time frame, you're going to see a bottom form, you're going to see the first leg up, however that looks, you're going to see a 50% pullback, and then you're going to see a new high. Because when you look at the chart, and when you study just basic price action, everyone knows that this is how a chart should look. Starts from a low, creates a higher low, and then it goes higher high. In practice, and when you're on the charts live, it's easy to talk yourself out of good opportunities because you think, oh, it hasn't gone low enough, or I want it to go, it went too low, right? You'll either say it's dipped too much or it's not dipped enough. You can overthink and you can talk yourself out of trades, when in reality, the path was already set. The path was already set by Luna, right? The path was already set by Luna when it did this massive break of structure here, right? When it had all of this consolidation and broke clearly out of it, you don't FOMO into these big green candles. But since it made such a move off the lows, your only thought should be, I need to get in on what looks like a higher low because I know it's going to go to a higher high and then extend beyond. That's the essence of trend trading. This is going to stop you and help you to not buy into green candles, because you can never buy into a green candle if you're waiting for a 50% pullback or 40 or 60, whatever. And when you get that 40, 50, 60% pullback, you're not going to be concerned because you know that that's part of the game. That's what you're looking for. And you'll know that market structure, higher highs, higher lows, remains undefeated, and your target is a new high after that. And then, of course, if you couple this with doing it after the base, you're hitting at the perfect psychological time. Because even though when you talk to someone and you teach them or you talk about markets, everybody knows that trends tend to have multiple legs, right? Typically at least 3. This method is designed to get you in after the first leg. The earliest time you can get into a confirmed trend. That's why you wait for a significant base, you wait for a rally up, you buy the 50% correction, 40, 50, 60, and you know it's going to hit a new high if the trend's valid, and since it was the first leg, there's actually also a chance that it goes second leg, third leg, maybe beyond before it finishes. The reason that's important is because at this moment here, that's where you have the least crowded trend. People love to fade the first leg of a trend. Why? I think it's quite simple. Because they miss the lows, they miss the move up, and so they only become aware once it's pulling back and they want to say, oh, it was fake. It was fake because they missed it. And that's the vast majority of people. But the big shift that happened almost guarantees a second leg. And then, right, after you have that second leg, it becomes more obvious to the market. So more people are going to buy here. It goes again, more people are going to buy here. And that's why your second and third legs they're often nowhere near as clean, right? They're more choppy and messy. And there's nothing wrong with buying them, nothing wrong with trading them. But you're not going to have any disbelief. You're not going to have an easy, empty trade. It's going to be a semi-crowded trade at the very least. So using this method, it requires patience and time. But that's simple. You just do nothing, right? You do nothing. You wait for the market to be really bad. You allow it to continue being really bad. You understand that it's probably going to be really bad for a long time. And you want to see a long time. And you want to see one of these nice rounded bases form. And then when it comes off the lows, pulls back, you can get in. So that's the first stage. Once a base forms, once a bottom forms, first leg up, buy the first 40, 50, 60% correction. That is the only time that you're going to have disbelief when it's in a confirmed trend. And it has to be confirmed, right? It has to be an impulsive, large breakout. And of course, you don't have to buy breakout. And of course, you don't have to buy on the way down. You can wait for it to actually stop at 40, 50, 60 and buy once it's stopped going down. Now, how to actually spot these moves developing, right? How to ride a trend up from the lows. Well, for that, we'll look at something called the Livermore accumulation cylinder. It's pioneered by Jesse Livermore, one of the greatest traders in history, from all the way back in the 1900s. And what it is, I'm sure everyone's seen this chart. I've shared it a lot. It gets misused a lot, okay? Everyone seems to want to find this chart playing out perfectly. Now, when you look at it, compared to this Solana chart, which goes off the lows in 2020, it looks the same, right? It goes 1, 2, 3, 4, 5, 6, 7, 8, right? Little dip, but then 9. Oh, it doesn't quite get 10, but then it sells off. So anytime you look at past charts, you can always find one that looks like it works. But that opens you up to a bias known as apophenia, which is the tendency for us to spot patterns. And it's very easy to spot patterns in the past when there's no pressure on and the market is quiet and you're looking at candles that aren't moving. When it's in real life, it's much harder for you to spot this, because what is this actually? Right? What's actually going on here? Well, what's going on here at this part, which is the only part you want to get in on, by the way. If you're trading this pattern, you don't want to be waiting until the late stages. Now, you can trade those in a different way, but your goal is to spot the 2, 3, 4, 5 parts, right? But the reason why it's difficult in real time is because this move from June 2020 was 40% down, and it scares people. This move was 45% down, and it scared people. Like, look at that. Solana just went up for 10 days and then wiped it all in one day. Right? People don't like to buy that. They don't like to buy big scary candles. You have to get over that. You have to become okay with buying big scary candles or buying after big scary corrections. Because the only way to make money in the market is to think differently to the 90% who lose money. And the only way you're going to do that is by conditioning yourself to do the things they don't want to do. Right? When it goes down 40% in a single day, they want to sell. They think, it can't go down 40% in a day and still be bullish. I have to sell. I have to get out. It's over. You're going to think those same thoughts. I've thought them. We've all thought them. It's your natural human instinct. It is your first reaction. It's your gut instinct is to think that way